Welcome to Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, starting off as we normally do with the S&P 500, there's almost a chance that your option structure, which would profit from a fall in the S&P 500, might work if we continue on what's happened over the last week or so.
Yes, it's possible. If you have a look at it, the S&P 500 chart is up on the screen at the moment, and what you can see is that the market basically is broken below the 50-day moving average over the last week, but it's also broken below this upward trend which joins all the lows from January of this year, and that's quite a significant uptrend. If you look at it, it touched in January twice, again in April, again in May, again in July, and again now in early August. And then finally now it's actually broken below the bottom of that upward trend. So that was quite a well-established trend line that has now been broken to the downside. So we need to see what will happen from here. If the market moves up and it fails at the underside of that uptrend, and also if it fails at the underside of the 50-day moving average, which comes in at around about 2440, 2445, that sort of area, then there's a possibility that maybe that would be a throwback and a retest to then give another leg to the downside. So let's monitor it and see. From a point of view of our option structure, you can see the payoff profile on the right-hand side over there. Now this thing expires on the 15th of September. So it means you've got about 3.5 weeks left to go in terms of time value before this structure expires. So what it means is if we do see any further weakness on the S&P 500 from these levels, then we actually could well end in the money on this thing, which would be fantastic for our portfolio. Of course, if it rallies and moves up from these levels, well, then we're not going to participate in that. But it's certainly looking like it has a chance at this stage.
I mean, and just percentage-wise, how much would the drop have to be, for us to start actually making some money from this, depending on where it expires on the 15th?
Well, basically below 2430 is where the structure starts to make some money, and it makes its maximum profit at 2380. So from where we are currently at around about 2430 down to 2380, that is 50 points, and in percentage terms, that's only 2%. So if the S&P 500 fell by 2% from here into our expiry on the 15th of September, that could potentially give us our maximum profit on this trade. So minus 2% doesn't sound like a lot, but let's see, it could go either way from here. But it is looking as if it's got a reasonable chance that we could actually make a bit of money here.
And just maybe remind us where you actually entered that. Was it in June or was it in July?
I think it was in June that we did this trade. So it's because at that stage when we did it, the 2430 was actually at the money,
yes.
and then it had that rally in July. So yeah, it would have been in June sometime that we put on this structure.
Okay, so it could actually get very interesting for the portfolio and would be a real boon, I think, because it has been a tricky year. What about the top 40? Because we were also essentially bemoaning the July rally that took place there, but it has petered out a little bit, and I sort of wonder what you see developing from here on out.
Yes, that's right. So that massive rally in July and into the early part of August, you can see there quite clearly. That trend line was broken last week. We spoke about that on last week's show, which to me indicates that we've seen that blow off top on the top 40 index, and now it's into consolidation mode. It's for the most part over the last week, or just over the last week, it's actually been very range bound between about 48,600 and about 49,250. It has actually pushed out through the upper end of that range today. We're trading up at around 49,500 as we speak at the moment. But let's see, it's still possible that this is in a consolidation phase. I think it is. I think it is in a consolidation phase that's likely to be with us for a little while longer still. In terms of the option structure here, we've got a put spread option structure on the top 40 index as well. This expires on the 21st of September, so it's a week later than when our S&P 500 structure expires. And this one gives us a profit if we see the market moving below 48,000. Now, that is it's about 1,500 points lower from where we are at the moment. So it's looking somewhat unlikely that we'll make money on this. But again, the 21st of September is 4 weeks away from where we are now. So it's not impossible that we could still see this one moving into the money for us. But as we sit here right now, it's not looking all that likely.
Yeah, and certainly the maximum profit is pretty far off from where we're trading at the
maximum
moment.
profit only comes in at 46,000, which is a very long way away. I mean, that would imply that the market has to fall by 4,500 points from here in order for us to get to that maximum profit. And I doubt that's going to happen. But again, you never know. Markets can be strange. But I'm certainly not holding out for that, I don't think.
Well, certainly we didn't really see the huge gain that was going to take place in 1 month alone, so it could unwind. Hopefully not, but there you go. Garth, so let's move on to some recent trades before we get to this week's position that you've taken, and that was a trade in Unilever, which does look as if it's working out quite nicely.
It is working out quite nicely for us. This trade is on Unilever in London, so its primary listing is in London on the London Stock Exchange. So we trade this on our offshore portfolio in pounds. And what we identified here was that the stock is actually in a quite solid upward trend. That trend line that I've drawn in, the diagonal trend line through there, goes back a lot further if I was to zoom out on this chart. And there's an inverted head and shoulders pattern here, which is what got me interested. And particularly when you see an inverted head and shoulders pattern like this forming at a high level, it often has a fairly good chance of breaking to the upside. So we took a view that this stock was looking as if it was likely to break to the upside and go into new high territory. And that's what it's done. So we bought 140 CFDs for the portfolio, and we paid £43.50 for those. The stop loss is £42.50, and we're looking for a move up to £46 here as our target. Now it's doing well. You can see that the price has broken nicely through the neckline of that inverted head and shoulders pattern over there. Today the share price is trading up north of £45. So it's looking good. It certainly looks as if it is on its way to our target price of £46. So we're happy to sit tight here and hold this one for a bit longer still.
I mean, this hasn't happened sort of straight out the blocks, but it has been a fairly steady gainer. How do you sort of feel about that as a trader? Because I know you like, and certainly any trader likes to have some sort of immediate profitable trades.
Yes.
But is it slow and steady enough that you're still willing to hang on to it?
Yeah, no, I'm still willing to hang on to it, and you know, it was a little bit slow out the blocks, but having said that, we've never actually been in a losing position on this trade. It's been making money for us right from the beginning, and I've always maintained that the best kind of trades are the ones that work off the bat, and usually you get your result fairly quickly. So this one's looking good for us. It is working out pretty nicely, and I'm happy to keep holding it.
Okay, Garth, so getting to this week's trade, and we did allude to it last week. You said you were going to keep an eye on Clicks, and you have actually entered a trade there.
Yes, that's right. We looked at the chart of Clicks last week. I said at that stage it was our stock to watch for the week ahead, and that we would potentially look to put a trade on. And in fact, I put the trade on the day after we did the show last year. So
last week.
Yeah, last week, I beg your pardon.
I mean, a week is a long time in the market.
It certainly can be. And what I'd identified here was that the stock has been in a nice steady upward trend. You can see again that trend line touches a lot of low points on the way up since December last year. So that's a well-established upward trend. It pulled back quite nicely in the early part of August. And I said at that stage, if we see a reversal up off of that uptrend and off the 50-day moving average, which actually coincided more or less the same level, then we would look to buy. The day after the show last week, we did actually put this trade on. The price formed a reversal up off of that upward trend. So we went in and we bought at 143 Rand 60. Stop loss is 141 here, so reasonably tight. And then we're looking for a rally basically back up to the recent high, which is at 150 Rand per share.
I mean, it's quite interesting because I've been getting lots of questions on Stockwatch, and I think I mentioned this, and we did talk about it a little bit last week, on shorting Clicks. And I suppose the theory, I can kind of understand the theory when you look at the retail sector and you look at the South African consumer and you think, gosh, everyone is so under pressure. Why on earth is the share trading at or close to record highs? Therefore, I must short it. But as we discussed again on the show last night, that is not necessarily a good reason at all to short a share.
No, it's not. Look, Clicks is still growing very nicely, and it is in a space in the economy which is relatively inelastic, in a sense that it's not that sensitive to the economy. It's a pharmaceutical company, pharmaceutical distributor, if you will, and then a cosmetics company. So from that point of view, Clicks is quite well positioned and is quite defensive within the retail space. And also, it's interesting you mentioned the short, because in fact, Clicks on the reports I've read is in fact one of the most heavily shorted stocks in the market. And that in itself, to me, is reason enough to probably look at buying it, because when there's a heavy exposure on the short side, what's going to have to happen at some stage, those shorts need to get bought back in order to close them out. So what you end up with in a situation like this is where you've got a stock that's in a rising trend. That means that the buyers are naturally in control of the price action by and large anyway. And then you add in the fact that there's a whole bunch of shorts as well. Well, when they want to close their positions, they're also going to have to buy. So it means that you actually get quite a heavy bias towards the buy side in a stock that's heavily shorted, and it does introduce the potential for a short squeeze at some stage.
I mean, do you know how long Clicks has been such a well-shorted share? Because could one argue that to some extent the gains that it's had this year is as a result of the short interest, and it's just kind of worked against the short sellers in the stock?
Yeah, it's only recently started to pop up on my radar as one of the most heavily shorted stocks. So I don't know that this year's gain has all been about short covering, but I think the fact that it's now starting to pop up as a very heavily shorted stock makes it interesting, and it does potentially make it vulnerable to a short squeeze.
Okay, so take us through the mechanics of what you've done there.
All right, so we've gone long at 143 Rand 60. The stop loss is 141 Rand. That means that our risk per share is 2 Rand 60. I'm risking 1.5% of our portfolio here. So we've got about 104,000 Rand in our South African portfolio at the moment. 1.5% of that is 1,560 Rand. So in order to calculate our position size, we take the capital risk of 1,560 Rand and we divide that by the risk per share, which is 2 Rand 60. And that gives us 600 CFDs. So I've gone long 600 CFDs for our portfolio this week. The target here is 150 Rand, and that means therefore that my risk to reward ratio on this trade is 1 to 2.46.
Garth, the position size, firstly, 1.5% of the accounts. Your maximum is generally 2%. Is there any particular reason why you've taken a slightly smaller position?
No, not any particular reason really. I think it was just a gut feel to take that size risk. We've got some exposure on our offshore portfolio, and then obviously we've got our options on the South African portfolio. That's the only other position we have on the South African portfolio. So I suppose I could have gone up to the maximum risk here, but I didn't. I just ended up choosing the 1.5%.
And then the target of 150 Rand, so close or at the previous highs that it's touched this year. But it's not a very stretched target, is it? And I kind of wonder if you this year have maybe scaled back expectations, if you've lowered your expectations as a trader, and also where shares might trade to.
Well, what I've learned this year is that often the kind of follow through that you're looking for in these stocks doesn't always happen, and you can find that a stock gets halfway or 2/3 of the way to its target price and then it stops. And that has been very, very frustrating this year. And for a vast part of the market, that's been the case. Actually, if you scratch below the surface, there have been a lot of stocks that have done that, which have been very frustrating.
No, and then a couple of that haven't, and I suppose that's equally frustrating when you're not in long positions like Naspers, which we were in, for example.
Yes.
So what does the portfolio look like? It has been a fairly busy period for the last couple of weeks or so.
Yes, so here's our South African portfolio. It's looking okay. We are up on the Clicks position, which is great. So we're up 2,200 Rand there. So that adds to our value of our South African account. We're sitting with 106,500 Rand there. And then obviously we've still got our put spread option structure on the top 40 there, which runs out for another month from here. And then on our offshore portfolio, things have improved a little bit this week as well, with that Unilever position having gained. You can see we're up £208 on that Unilever trade, so that's looking good. And then of course we've still got that put spread structure on the S&P 500, which we're monitoring. That expires on the 15th of September, and as we said, it's not far away from going into the money at this stage.
Yeah. And then just to end off with a note of our weekly alerts.
Yes, that's right. If you want to subscribe to see what we're going to be doing on the show each week, go to traderscorner.co.za, and you'll see in the middle of the page there's a link for a free weekly email. Sign up to that. It's quick and simple and straightforward, and we send you an email every Tuesday afternoon detailing what's coming up on the show for that week.
Great. Garth, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.